Man, welcome to the closing beat, everybody. Happy Tuesday to you. How you doing out there? You had country music going? I feel like going to the mountains, man. Checking out the leaves changing and stuff. That was Tim McGraw, too? All right, a little country music and jazz wealth here today. We are financial advisors at Jazz Wealth. Not country wealth, Jazz Wealth. And I hope you check us out at jazzwealth.com. While other advisors are playing checkers, we are playing chess. And here's a great example of this. Working, of course, we use Goldman Sachs as our custodian. I was thinking earlier, I want to check in on the transports of our portfolio. And I was like, well, all right, let's see what kind of data I could pull up here, see how things are going. And these guys at Goldman Sachs, they have everything. Here are the actual satellite data from a company that they have a small partnership in of the shipping backlogs. I thought this was fascinating. The West Coast not having any problems. Out in the East Coast here, slight little downtick there. And they're finding this data by including container ships that have been there within 140 miles and to the right of longitude 100 for more than 3 days. What? I was just hoping to look up some fundamentals, you know, check in on Union Pacific and CSX and stuff. And they're like, now let's start there. And then let's go through all the transports down to how long are the shipping containers being put on a truck, then sent somewhere and sitting. They called it street stale or something like that. My gosh, that is fascinating. We also cover fascinating stuff in our Wine and Wealth every Thursday for clients. Last week was a bit of a throwback. We had wine and we talked wealth. So if you're interested in that, any one of our clients, go into the dojo. You can check it out. It's always there. And of course, we do it live on Thursdays. This Thursday will be no exception. All right, let's go on over here. So the S&P at a very popular technical area. We're at the 200-day moving average. We're also at what they call minor supports, just the previous highs there. You can get a little more detailed if you like doing things like that. We also have ourselves back at the bottom of the uptrend. That's that blue line right there. We can, well, there you go. It's blue. And so we have a, basically, if you're looking over here, a nice little uptrend doing its thing, whatever, and then got a little too far extended, and it's been working its way all the way back to that uptrend ever since. It's kind of an important point because there are three technical areas that people like to look at: the 200-day, minor support, and an uptrend. If we find ourselves moving below this, we now have people that believe in the 200-day moving average, give or take a little bit. They lose faith. Those bulls get a little nervous. We have people that believe in minor support, which is a simple little pullback to prior highs. If that fails, they lose faith. That's two people. And if we break the longer, more established uptrend here, that's three people. Times that by all the people that believe in that sort of thing and everybody else that just kind of wants the market to go down. And now you have a recipe for maybe some weakness in the short term. For the moment, that is not true. Everything is holding tight. We're right here in that window of those three different strategies. You could also argue maybe a Fibonacci pullback there as well, people that like that sort of thing. But I think the wish, if I could have anything I want, I would hope that we gain a little bit of a ground here, right? Just a couple day rally there, which we'll likely see tomorrow with some of the earnings that have come out. But if we can gain a little bit of ground, and then Israel does invade, does the ground invasion of Gaza, and that hurts our market for just a little bit, just be a little volatility there, well, we've got some slush to work with, right? That's the major sort of, thing that's on the horizon, aside from earnings and the GDP number and things like that. If you look around, take a look at the NASDAQ here. It's much stronger. It is at a support area. It's just not as obvious. There's less participants there. This one would have more room to pull back if it wanted to. You wouldn't really think much of it. If you like Bitcoin, I don't know. I just started pointing it out. For a moment there, you were over 35,000 today, 35,265 to be exact. Looking at the Bitcoin futures, it did pull back. It is getting a little crazy. What's going on there? Are you chasing that? What's going on, man? And then you got the Dow. Pretty much like the Dow and the Russell are on their own, they're playing their own game here. I don't know what's going on with these. Very boring, very quiet. The Russell, very extended in the short term. It's the most oversold index out of all of them. If you like your small caps and you believe that the economy is actually going to grow like 4% in the third quarter, that would be good for small caps there. But for the moment, we're not seeing a whole lot else to get like super fired up. It's a dip your toe in the water kind of a thing. Looking over at bonds, a little bit of a split bond market here today. The volatility likely continues inside of this space here. Anything related to it had a bit of a choppy day. So nothing, Nothing really to report home about short term, long term. We have a bit of something called the bear steepening happening right now in the yield curve. Bear steepening would be that longer end steepening, not the shorter end, which created the inversion. Historically, you can't run data. So before somebody asks this, is a bear steepening curve good or bad for stocks? Is it good or bad for individual sectors? And if so, which one is it good for? What do we do? That's a tough one. I started going down that path, but the reason it doesn't work is because we've had bear steepening curves in the midst of the pullback since 2008. In other words, how do I show it? Give me a second here. I'm trying to... This is not a great example. Okay, so just pretend this is the curve, right? This upward movement would be the bear steepening part of the curve. Well, if you look back since the financial crisis, we've had a ton of these little bounces along the way while interest rates were coming down. Those moments in time, yes, they've been good for stocks, and that helped kind of keep things going. Everything was good there. This time may be different because the bear steepening is potentially more of a bottom, right? More of a longer-term stable support area there. So careful. If you run any data on that one, you might find some data that gets you excited, but I think you got to look at it this time as we know that rates aren't coming down for the next year, something like that, something to consider. Elsewhere, not much else to report. Gold, remember we talked about this, gold running up a very steep hill very, very fast. You can't do that. You can run a marathon on a flat road for a long time. You can run even slightly uphill for a long time. But most of us, I would venture to guess all of us, can't run up a steep hill and just keep going and going and going and going. Well, gold ran up that steep hill. What's happened since then? Roughly in the area we were talking about. Not a lot of activity, right? Not a lot of excitement there. Did we hit oil? No. Prices of oil pulling back as well. This is going to be your wild, I don't know that now's the time to bet that you're going to guess a trend on oil that just rips like a Forex product or something. I wouldn't be the one to do that. Too much geopolitical movement going on out there, and likely, or it seems at the moment, that it will be escalating. Okay, let's take a look at some of the stocks here, because there's a lot. You want to talk about earnings and whatnot and all of that. Nextera, we got ourselves a little bit of that in our funds here at Jazz Wealth. Obviously, it's been under extreme pressure here. Hey, we're worried, rising rates, maybe that starts to slow or hinder their investment plans. These guys had major investment plans there. They come out with their earnings and they're like, hey, the third quarter here, we beat across the board there. Our margins are higher than expected, which will allow us to continue to do our expansion plans and everything. Oh, and by the way, we had a lower income tax rate than expected. Well, there you go. That's your reason for that one being higher. Kind of interesting to see so much doom and gloom translate into, oh, wait a minute, it's over fear, or shouldn't be worried. Spotify, you might have caught this one here today. Pretty much better across the board. If you look inside their metrics, this is a lot like Netflix. You can look at monthly active users, premium subscribers, the ad-supported users, not really subscribers there. So they come out with their earnings. Obviously, everything is very strong there for them. The stock is higher by quite a bit today. But we now also find out they're taking more and more market share. Now, that's helpful. Right? You like to see that. They are capitalizing on, how would you say that? Capitalizing on the global growth opportunity in streaming, music streaming. That's what you probably see on TV. I just broke it down a little bit more plain English. Verizon, we happen to own a little bit of this one as well. You know it. Prior to today. So they reported earnings as well. Beats on most of their metrics across the board. Subscribers, I think the focus today was that free cash flow, because not only do they have a higher free cash flow than expected, but they guided forward for higher free cash flow. That is good when it comes to what to spend that free cash flow on, and they've spent it on dividends. They're no dummies. They know the game, right? We are here in the economy. We talked about this yesterday. How do we get our stock to start performing better? We can show strong balance sheets, which is high free cash flow and projected to be even higher free cash flow, and we can return money to shareholders. Dividends. You know what I mean? They know what they're doing. They're no dummies there. We'll cover a couple others here in just a second. Something interesting coming out. This is getting a little out of hand here. Advanced GDP numbers are going to be coming out here, and the expectation from the Fed is to see advanced GDP at 3.6% just for the third quarter. That's higher than we've seen. So let's try this here. All right, here's where we've been, right? If we track GDP numbers and we start going back, we have a 2% growth rate. You could draw a line, basically you find yourself a little average right in here of 2%, okay? We come out of COVID, obviously we went nuts and spent a bunch of money. So if you come on over here and go, all right, we're about 2%. Magically in the third quarter, analysts are suggesting north of 4%, okay? If we have that, that's basically getting back to the pent-up demand of the COVID days. So what that suggests is we have had higher interest rates and higher growth. Higher interest rates, higher growth. Wait a minute, how's that work? Do you find that in your personal life where, I don't know if you have credit cards or adjustable rate mortgages and HELOCs and things like that. Have you found that with higher rates, your spending and your total family's net worth growth has gone up? How's that work? Right? So looking forward to that number actually, because I don't want to be skeptical. I'm pro America. Let's go. Let's grow. Let's have a great thing. But I just not sure I understand where we're coming to that from. And I looked real deep into it to figure out all the different metrics we're using. It's not a lot of growth going on there. So I look forward to seeing what's happening there. We are seeing growth in terms of some of the bigger names, actually. We want to look at something like, Alphabet after hours, Microsoft, not necessarily the stock price, but Alphabet after hours, Microsoft certainly after hours, 340, almost 350, going up in that category. Actually, that's going to put it, right now, it's like right in here, right? And so looking through their earnings and of course, everybody else's earnings, we're seeing growth, right? So from a public stock standpoint, I guess, but I'll admit I'm a little dumbfounded on that one. All right, Raytheon, which is a new one for us here. Geez, what happened to Raytheon? Such a good day today, up 7% or so. What could possibly be going on? Oh, they reported better than expected earnings. Revenue is stronger. Everything looks good there. Raised their guidance going forward. All right, so it's a beat, right? We almost had a beat in here. That didn't do it. We almost had a beat in here. Right in here. That didn't really do anything. What's going on? $10 billion of share buybacks. So somebody over there at Raytheon watched the show yesterday and said, okay, let's use Dustin's cheat sheet. So we are here and we're Raytheon. We have a strong balance sheet. Oh, return cash to shareholders. Let's do that. If we return by share buybacks, if we do that, stock will go higher. There you go. So they're no dummies. They watched the show. General Motors, of course, reporting their earnings and got the strike thing going on. They beat overall on earnings there. A couple things notable to me. They got rid of their guidance because they don't know how this strike's going to pan out. I think that's understandable. I have no problem with that. They also said, we are going to moderate the acceleration of our electric vehicle production. They didn't say stop it. They just said, we're going to moderate that. In other words, instead of going gung-ho, wait a minute, these costs are really, really high. We can't seem to get it more efficient like Tesla is right now. So why don't we just slow things down a little bit? Let's not take such big loss. Let's not invest in our CapEx as much as we thought we were going to do there. Let's slow this thing down just a little bit. And that's what happened with them. I think the biggest thing was people wanted to hear more about the strike and everything. And that's, that's what's going on. Here's a little different way to look at it. Cleveland Cliffs. This is like, steel and aluminum and stuff that comes in a big old roll. These guys are kings of doing it. Have been doing it since any of us have been alive. 1800s, very old company here. Anyways, the stock is higher here today. They come out with earnings better than expected. Yeah, all that's good stuff. The stock price goes higher, though. So I'm like, let's look a little bit deeper. What did they decide? All right, they said, we are here. Okay, let's see. So investing for growth. Oh, we were doing that. Let's just not do that as much. Okay, good. And what happens? Stock goes higher. Reducing CapEx. Stock is rewarded. All right, fun stuff. Ooh, Logitech. This is an overseas one. I wasn't really going to talk about this one. It's a breakout play. So from a technical standpoint, if you like that sort of thing, then it's probably on your radar already. Earnings beat by about 100%. More than what we expected there. So obviously things are going well with them, except for like the cameras and stuff. I don't know why. Gross margins, 4.5% higher. You like to see that. Sales were up. The future is up. The stock is up. Everything's up. So it's up. It's good for them. And lastly, or we can cover others if you like, but I'd like to point these guys out. HESAY. I know what they are. I could just care less about this. You guys like your Hermes, the belts and the shoes. Cody, do you have an Hermes anything?
I don't know what an Hermes is.
It's with an H.
Hermes?
Hermes. It's kind of like herb.
Like is this like a Floby? Hermes? Hermes?
No, you really don't know what you playing?
I don't know what you're talking about. I genuinely don't know what you're talking about.
They make cowboy hats.
Oh, I wear a lot of cowboy hats.
No, I'm just kidding. They make fancy stuff. They're like a Louis Vuitton, overpriced things. And that's why none of us have really care. Anyways, I just wanted to point out, you guys apparently like these, because I looked into these guys. They had their earnings come out, and their sales growth alone in the United States for very overpriced products that we could just go get at TJ Maxx, up 20%. And they said, we had a whole bunch of price increases, and it didn't slow down our growth. People still bought all this stuff. Kidding me? Come on. I said the other day, right? You go stop spending money, right? And somebody left a comment where they're like, well, how are we supposed to stop spending money when gas is whatever it is, and all that stuff. I'm like, yeah, that's not what I'm talking about. That's what I'm talking about. Let's see, Hermes. What you guys doing there? Hey, Jazz After Dark, if you want to check it out, we talked about using a Roth IRA to pay off your credit card debt and not hurting your retirement, having more money each month to spend and making up the difference. How would you go about that? And of course, I realize that you would only be taking out your contributions. Your Roth IRA, you could take contributions out anytime. You won't be penalized. You won't be taxed. So something to keep in mind. I'll take your questions if you have any while we're letting those questions load, because there is, I believe, a slight delay. Let me go on over here. You've got Boeing, Norfolk Southern. It's the reason I was looking into some of this, the transports there. Norfolk Southern reporting, Ryder, T-Mobile, IBM, KLA-10 Core, Meta will steal the show after hours with earnings tomorrow, and then O'Reilly and Whirlpool. United Rentals also. Yeah. GM is worse than new mods. Oh, you one of those? You like to do that? You cheering for a GM to come back there? I mean, I don't know if that's 25%, but I get what you're saying there. It's a discount there. Yep. Hermes. Sounds like a Jay-Z. Well, $500,000 to have lunch with him, by the way. Yeah. Restoration Hardware. Yeah, that's the one I always give them grief. Have you seen that, by the way? Look. What? Warren Buffett invests in Restoration Hardware. Oh, my God, I'm going to buy it, too. It didn't work out. I guarantee you it worked out for him. Oh, no. That's like a mountain. It's crazy. You kind of like Malibu boats. Oh, it is? Yeah. I don't get it. Malibu boats, yeah. They're selling the devil out of those things. Yeah, we own that. Where did we buy that? We had it before COVID. We had it before COVID. I want to say we have like 0.2% of it or something left. It was one of those where you're like, what? If people are going to buy the crap out of this thing, then we've got to sell it to them. Take that approach, by the way. If you're in a stock and you've more than hit your target and the stock is going crazy, or it's Bitcoin, I don't know, it's going crazy. Think about it that way. If you don't sell to somebody who's so eager to buy those shares, then the stock can't go up. Like, they'll get bored. They'll go find something else. If they want to buy so badly, go. Give them your stuff. It's a great analogy for life. Get a hat will save USA. Oh, we may have some hats coming now. That is true. American-made hats. Yeah. Hermes men's belts start at $800. Yeah. Like, you could just buy those pants that have not a belt, but they have what's that called? Like the pants you just put on and you know what I mean? Jenkos? Yeah, the pants, you put them, they have a stretchy waist, old man pants. You put them on and they just kind of, bloop, you don't need a belt. I just saved you $800. No, I'm trying not to say it. I'm talking about the shorts I'm wearing right now. Drawstrings or whatever. You know what I mean? Opinion on FCX almost recovered 2 days of losses. You like your FCX now, do you? So, there you go. So there are a lot of things that look like this. About a week or two ago in our Notes from Jazz, I was pointing out the stocks that are oversold, which is weird because the market at that point was trying to go up. And it's like, well, look at a lot of these stocks are oversold. You have yourself something that's discounted and finds itself oversold. So anyone that says, I'm going to dip my toe in some FCX, give it a shot or whatever, I can't blame you for that. Chaps. Yeah. Yeah, that's my nighttime close there, man. Easy now. Don't get me started on that. All right, we have covered everything we need to cover here today. We will be back tomorrow, of course, to do it all over again. I do appreciate you guys watching. You guys have a great rest of your evening, and we will see you tomorrow. Adios.